You look at copper and gold price and go back to 2011, you say, well, good grief, why isn't silver up there? If silver were doing what copper's doing, it'd be above 50 right now. On a relative basis, silver is still very undervalued to gold, very undervalued to even copper. And I think it'll do a catch up. One market with the greatest percent movement, whether down or up, I think it's silver. Would have the greatest percent gain. And probably the gold miners as well, because we know that they're, you look at a long-term spread chart of, let's say, the XAU index, which, originated back in the 1980s, and compare it to gold, we're off the page cheap.
Copper and gold have recorded multiple all-time highs in 2024, indicating robust demand and favorable market conditions for these metals. In contrast, silver has yet to reach its previous peak. Nonetheless, many experts believe silver presents a bigger opportunity than copper and gold. One of the main reasons for this optimism is the significant industrial demand for silver. Unlike gold, which is primarily an investment and ornamental metal, silver has extensive applications in various industries, including electronics, solar panels, and medical devices. As technological advancements continue and industries expand, the demand for silver is expected to rise substantially. The shift towards renewable energy sources further enhances silver's prospects. Solar panels, in particular, rely heavily on silver for their conductive properties. As the global push for greener energy solutions intensifies, the demand for silver in the renewable energy sector is likely to surge, driving up its value. This is one of the numerous reasons why experts like Michael Oliver, the founder of Momentum Structural Analysis, describes silver as the bigger play for investors in 2024. In a recent interview with CapitalCosm, Oliver, a 50-year veteran in the commodities and resource stock space, shares his outlook on the markets in 2024. Oliver says the stock market is showing many troubling signs that many investors are yet to catch up on. He predicts a bubble burst similar to the tech and telecom bubble burst in the early 2000s, which he says will begin after central banks, including the US Federal Reserve, start cutting rates. Unlike the consensus that rate cuts will contribute to higher stock prices, Oliver says the only assets that will benefit are commodities and commodities stock and bond yields. We will present clips from the interview. But before we do, please take a moment to share and like this video, subscribe to the channel, and activate post notifications for more videos like this. Thanks for watching.
The integration or the inverse or the correlation between certain markets has never been more important. You can't just, like, if you're a gold bug, you just can't look at gold. Really, it's a stupid thing to do. You need to be looking at what's going on in government debt markets, U.S. stock market in particular.
It's all intertwined.
Yeah, et cetera. Yeah, they bump into each other like icebergs, okay? And I happen to have a view, though, that gold tends to lead the events. Most people look at gold just like they do the stock markets. Oh, a data point today. It means
that's what it did in 2020.
Yeah.
Gold ran first.
It ultimately, it leads and anticipates the unfolding of events that later come. You look back and say, damn it, knew it, and I think that's why gold has been doing what it's been doing for the last 3 or 4 months, but especially the last couple of years, where it just persisted up at that 2,000 plus level. Just, they'd knock it down and it'd come back up again. That's not a top. You go look at history of tops, you don't top that way. You go back and look at old highs in gold, and when you made a high, you made a high, period. It was over. You never came back to it. You might have tried to, but you didn't come back. But coming back to it again and again, even price was telling you something, which a lot of people overlooked. Anyway, so gold is now broken out, and I think there's our argument is the stock market's been topping since early 2022. And even though the S&P and NASDAQ have made single percentage new highs, especially S&P, largely due to very, very limited, heavily weighted some, but it's a very narrow market now. And we know in history that that's not good. But forgetting that, the momentum technicals of the stock market tell us, one, we've had the biggest stock market bubble in U.S. history in terms of the percentage gain since 2009 and the duration of the bull market in terms of years. You go back and look at 1923 to 29, look at the peak in the mid-1970s, look at the peak .com. It's like a 4 or 5 year bull run. That's all. triple, quadruple, that type of thing.
Yeah, it's unprecedented.
Yeah, it wasn't, they don't compare to the bubble we just created in terms of the dimensions. S&P has gone up 7-8-fold since 2009. NASDAQ 100 has gone up 17-fold since 2009. There's no comparison. And you said, well, because the economy's strong. Well, look at an M2 chart. St. Louis going, you look at an M2 chart going back to the 1950s, and it's this upward curving thing. Doesn't matter what decade it is, you almost double the money supply every decade. Now it's even more this past decade. And then look at a Fed funds chart. The Fed funds chart is, they dropped rates very low. I think it was 25-year-old low back in 1994, 95. And what followed was the dot-com bubble. I think gold knows that because it knows that every time that stock market tops and then turns down, look at 2000 top, for example, or the 2007 top, followed by a bloody bear market in the stock market, gold goes up. And also T-bonds go up, interestingly. Now, lately, the T-bonds have been going down, meaning higher yields, along with the stock market. But they're about to turn, I think. About to have a sharp, probably several quarter rally in the T-bonds.
I see.
And this is exactly what happened in 2007. In September, it was mid-September 2007, the Fed had been raising rates for a couple of years, up through 2006. They paused, and then in 2007, in September, 1 month before the top tick, Bernanke cut rates by 0.5 basis point. And the S&P had this last 4-week, 3 to 4 week rally into mid-October, and that was the top, okay, even though they cut rates. But if you look at what happened to T-bonds and gold then, it was very similar to what T-bonds and gold did in early 2001. They took off upside while the stock market went down.
In 2022, central banks started jerking up interest rates after at least a full year of excessive money printing. For example, the Fed has pushed its key rate to a 23-year high of 5.3% in an effort to bring down inflation, which peaked at 9.1% in June 2022. There were expectations that the drastic move from near-zero interest rates to over 5% would plunge the economy into severe recession. While that has not happened, the Fed's activities have certainly had an impact on the markets and the broader economy. Oliver predicts the impact will be even greater when central banks eventually begin cutting rates. He explains that though they will try to downplay the importance of the rate cuts, when they finally come, the stock markets will react badly to them. In contrast, Oliver predicts rate cuts will be great for gold and bond yields. This is even greater for the silver and mining sectors, which Oliver expects will significantly outperform gold in what he describes as the second leg of the bull market. Let's get back to the interview.
And in the case of silver and the miners, while gold went sideways, they staircased downside. They underperformed after a massive outperformance surge that they enjoyed in the summer of 2020, where they beat the pants off gold. But then after that peak, they gave back their performance gains. That too has shifted. If you measure, and we measure it via spread charts, silver versus gold and GDX, for example, versus gold. We plot like monthly closes. Where's GDX in relation to gold as a percentage? Where's the price of silver as a percent of the price of gold? And we plot that, and we also run momentum studies of it. But they've both broken out, meaning that underperformance trend that we had for 3 years, that trend is technically broken to the upside, meaning going forward, probably over the next several quarters, the miners in silver will beat gold again. So anyway, that to us, that spread relationship shift back to outperformance is what happened also late in the 1979, 1980 bull trend, when all the metals went vertical, and what happened in 2010 to 11 in the last year of that bull market. So in other words, when you entered the acceleration phase of that gold and silver bull market, where silver beat the pants off of gold for the last several quarters of the bull market, I mean, it rampaged ahead of gold. The spread broke out and told you that I've broken out, I'm now going to get into gear against gold. And not only did their price turn up dramatically in an acceleration mode, as opposed to like an arm wrestling type trend, which had prevailed for years, up, down, but gradual up. The spread also said, yep, that's what's happening. That's what's happened now, actually since late March, especially in April, all these readings broke out. Annual momentum of silver versus gold, GDX annual momentum broke out over a ceiling, the spread versus gold. All these metrics flipped and said, the trading range that you lived in from 2020 to 2023, or late 2023, is over. Forget those metrics. They only applied to Dallsville market. And frankly, if you get a logarithmic chart of silver, go back 50 years, and look at what happened in that last 3 or 4 years, it's one of the dullest, most narrow ranges of ink that you've ever seen in silver, and it's extremely dormant. So to use that time period as a norm, and so any norms that you got from that were abnormally low volatility. And so now we've broken through that stuff. So everybody's saying, oh, silver's overbought. Yes, it is by those standards. But you can go back in the history of silver and find periods like that where you've had these little tight little clumps, and then suddenly for like 3/4 of a year, it just goes vertical and makes up for what it had not done before. And I think we've entered that phase. And I don't think most analysts are quite yet aware that reality just changed.
The dynamics of the silver market further contribute to its appeal. The silver market is smaller and more volatile compared to gold and copper, leading to more pronounced price movements. This volatility can offer substantial returns during bullish market conditions, making silver an attractive investment for those willing to take on higher risk for potentially higher rewards. Additionally, supply constraints in silver mining, such as declining ore grades and limited new discoveries, could limit the availability of silver, further boosting prices as demand continues to grow. Monetary factors also play a role in silver's potential. Historically, silver has been used as a form of money alongside gold. In periods of monetary instability, silver often gains renewed interest as a store of value, potentially driving up prices. Many analysts perceive silver to be undervalued relative to its historical performance and compared to other metals. This presents a buying opportunity for investors anticipating that silver prices will catch up with or even outperform other precious metals. What price levels do you anticipate for gold and silver in the coming months? Please share your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.